hear real quick what your businesses are, so I have some idea? What's yours?
Computer has, advertising,
Okay, bakery?
Music school?
Music school, okay, nice.
staffing,
Staffing agencies, okay. Med spa,
creative design firm.
creative design,
Paralegal services.
paralegal, great.
Lawn care and landscape.
Lawn care, landscaping, okay.
Financial, you told me that.
Right, financial earlier, and
Hair boutique.
hair boutique,
Med spa, excellent.
okay, med spa. And can I ask you to turn your name tags around, that perchance, even though I'm in my older years, I might be able to read them if I need to. Thank you. So, as he said, my name is Terry Seltzer. I'm actually an attorney, and I have several businesses of my own. To give you a quick rundown. My first business, I opened it at age 23. And then I went into law school, and I sold part of the business and closed down the other part of the business. And then, when I finished law school, I went into the securities industry for 7 years. And then when I finished with the securities industry, I left and I went ahead and started my own law practice, which I've had for 10 years. And then I got married about 2011, yeah, that's right. I'd be embarrassed if you saw me do that, right? When did I get married to you? So in 2011, I got married, and we also have an importing business. So we design, manufacture, and import furniture, mainly student housing, and a lot of metal furniture, like some of the things you see in this room, actually. And then we also have a real estate business as well, commercial and residential. So I am all about business. And in my law practice, I practice in the area of business and real estate now for 10 years. And I say, if you see me at the courthouse, I'm in a lot of trouble because I do not handle litigation. I'm the contractual attorney. I draft all the agreements that you guys will have between your businesses and yourselves and maybe someone else that you're doing something with. So I'll turn back here to the paralegal. What's your name?
Katrina.
Katrina?
Katrina, yes.
What's your area?
Well, it's still expanding, but now family, criminal, and personal injury.
Okay, yeah, you'll see her at the courthouse. And her attorneys, but not me. No thanks. All right, so we had a technical glitch this evening, so I'm gonna be operating off of my notes and off of the slides. So pardon me if I make any errors in my process here, just to let you know.
My fault.
No, I see, I wasn't gonna do that to you.
My
I wasn't gonna blame anyone. All right, so does everyone have a copy of the slides?
Yes.
Okay, good. And feel free to ask questions as well, but if it's getting a little long, I'll say, please see me at the end of the class and I can follow up with you then or in the hallway or something. Because I do want to answer your questions and make sure you have the information that you want. Okay, so we're gonna cover all of the exciting topics. We should really teach this course in October because it's kind of like doom and gloom around Halloween. So we're gonna be covering your business and all the different ways that you can no longer be with your business. So the major ones are divorce, dissolution, disability, and death. Doesn't that sound like fun? I told you, it should be around Halloween that we teach this class, right? But there's some positive things to it, because dissolution can mean what? Anyone have an idea?
Dissolving.
Yeah, but it means you could what?
Sell the business.
You can sell it, so somebody could give you some money for your business, right? Or you could sell the assets out of the business. And so dissolutions are probably the only one on there that is positive to you. Some of the other ones might be positive for some of your family members, right? Okay, so those are the 4 Ds that we'll cover. And that's also, by the way, what should be in your agreements. How many of you have LLCs in here? Some of you formed good. Do you have anything else? We have C Corps, S Corps. You have C Corp, okay. You have an S Corp, okay. And does anybody still have a sole proprietorship? You do, okay. Anyone with partners? That's okay. Go ahead. Anyone with partnerships? Nobody's partnering with anybody right now. Not even with like a sister, husband, kind of? Sorta, kind of, maybe. Okay, is anyone thinking about it? Wife, okay, kind of. So spouses are very different than having a partner that you're not married to or related to. The spouses in particular fall in different category. We'll cover a little bit of that. Okay. If I'm going too fast or you miss something, just wave at me and ask me again. I'll cover it again or whatever you need. Okay. All right. All right, so let's talk about divorce and family law issues regarding this, because one half of everyone in the United States apparently statistically will be divorced. That means you can divorce your right half or your left half. I'm kidding. You're gonna divorce a spouse at some point or other. You're gonna probably go through that. I've had to go through that. So one of the things that people wonder about when they get divorced is who owns the business, especially if you started it and you created it from scratch and you did everything. So anybody have any ideas on that?
It's 50-50 if you guys are, if you started the business after marriage.
That's right. So if you were married and you started the business during the marriage, they automatically own one half of the business. That's correct. So what happens if you get married though and you already have the business and now you're married and your business is growing? What happens if you get divorced now? Anyone have an idea?
Personal
You
plan.
just.
You think it's all yours?
Yeah.
Okay.
Would they get half of the profit from the business, like from the time that you get married until the time of the divorce?
That's exactly right, yes. So what happens, it happens like this. So let's say that you had a business when you got married and just for easy numbers, it was worth $100,000 when you got married. And now that it's grown to $200,000 and you decide you guys aren't gonna stay together any longer, you're gonna get divorced now, right? You're gonna get that $100,000 in value from the business and $50,000. Because the $100,000 that it grew while you were married, he gets, or she gets to have half, your spouse gets half. So you keep $150,000 of value, they get 50. Because the $100,000 that it grew while you were married is there. Does that make sense to everyone? I didn't lose anyone on that. Okay, so that's how that works. Now, there are some other things you can do to have your spouse sign off on that. And we can talk about that too, but you can do basically a spouse will sign off inside of your agreement and they can sign off. You can have prenuptial agreements, you can have postnuptial agreements, and you can even have a cohabitation agreement. Because if you're living with somebody in the state of Texas for more than 6 months and you're sharing bank accounts or other things and you're holding out to others that you're together, you look like you're what?
Yeah.
That's right, married, no, married. Common law marriage in Texas, that's right. So that's a whole other issue. So now all of a sudden you living with this person, you have this business and they say, well, I deserve half. And you say, no, we're not married. And they say, well, let's see if the court thinks we're married. Yeah, I've seen that happen. I've seen someone lose a couple $1 million that way with a girlfriend. So it happens. Common law marriage is serious. You need to consider if you're living with somebody and what that looks like, and if you're combining assets and you've been with them for more than 6 months, and especially if they put money into your business, or if they helped you in some way to get it started, it's what we call sweat equity, they did work for you to get it started. Those are all issues that can come up over time later, and you could have to give them a portion of your business or the value of it. Does everybody?
Does that vary by state? Doesn't that vary by state?
It is, there are only 8 common law community property basically states, and then not every state has common law marriage, it varies. But that's what it is in the state of Texas. Why, are some of you from not from Texas right now? You're not,
Louisiana.
you're in Louisiana right now? Okay, so I don't know, you guys are weird in Louisiana. You have Napoleonic law?
We do.
Yeah, I know.
And it's not, it's further south.
You go this in Louisiana. Napoleonic law. That's very strange way to practice law. So, I can't speak to that. You'll have to speak with somebody who's practicing in your state if you have questions in those areas. Be straight with you guys. Okay, pardon me. There's the class. We want to see what's going on. All right. So we covered common law. We covered living together for 6 months or longer. Also, watch it if they're involved in the business or they're putting money into the business, okay? Because you could actually owe them something. All right. We covered the value of this before and after. All right. Anyone who have questions about prenuptial agreements what a postnuptial agreement is or a cohabitation agreement. Also, I don't know if anybody in here, does business or has done business with people that are gay or anything like that, but this actually applies now to folks that aren't. So if you have those situations or you've been married in a state where it's legal or something, these are also going to apply to you now. It's gonna change, it's changed the rules, basically, even if Texas pretends like it hasn't. You could end up all the way in federal court on something like this, just so you know, give you an idea. Yes, yes.
I have a question. So what if you're in business with a person and you're not living with them and you're not in a relationship with them, you're just business partners, and then they get married?
Very good question. Right. Okay, so this is how that's gonna work, and if I need to put it on the board, maybe I should. I'll do it like this. This is gonna get a little complicated. All right, so that's a really good question. Anyone have partnerships? There was one, somebody else had partnership possibilities in here. You were thinking about it. You were, two, anybody else? No? Okay. So this gets interesting. So let's say you've got, do it like this, I guess. All right, so we've got a single person here, right? I'm sorry, board's moving on me. Single person here, and we've got a husband and wife over here, right? And you have a business. So it's owned what, one half, right? And one half. Is that right? Okay, so that's how it's gonna look, basically. So if you have $100,000, you're gonna have $50,000 in value over here, and $50,000 in value over here. Both of them, okay? Now, what does that mean for this person, this single person? So you're the single person and you're partnering with somebody who's getting married or who's married?
Just got married.
Okay, so you need something called spousal consent, basically, which is what you get in a management agreement, operations agreement, or shareholder agreement, depending on the type of business that you have. What's the type of business you have?
It's a lawn care landscape.
Okay, but what, is it an LLC?
It's an LLC.
It's an LLC. Okay, so you're gonna have like a management or operations agreement or something along those lines. And in there, you can have what they call spousal consent. You have a document in that agreement that makes this person's spouse, let's say it's a husband, and let's say that you and her were partnered originally, okay, you and the wife. And then she gets married to husband. So husband needs to sign the spousal consent, basically saying, I'm waiving all my rights to this business. But that doesn't mean that they're waiving all their rights to the value of the business, okay? What that means is they are not gonna be in here if they get divorced and now all of a sudden you've got 25% and 25%, right? Sorry about my handwriting and this board moving. Where they're all of a sudden 25% owner and they wanna run it and they want 25% stay in the company and 25% of the profits and all this other stuff. That's not what this means when they sign spousal consent. What it means is these still stay the same. Husband's going bye-bye somehow, whether it's a divorce or whatever, right? And so he's still entitled to, well, the equivalent of 25%, but really 50% of what she owns, right? Is everybody with me on this? Okay, so if he's going bye-bye, he still needs to get his money, but what it means when you do the spousal consent agreement is that now, if they're getting divorced, is that he has to get that from her some other way. So they're gonna sell their house, you know, their car, take money out of the bank account, and they're gonna give it to him till he gets this 25% in value, and he's gonna go away and take that money, but he will not have any ownership in this company. Okay? Yes, ma'am?
Will that mean that they won't liquidate the assets of the company to get to that 25%? Or is that saying they're not touching any part of the company in order to get to that 25%, or they just going after personal assets?
That depends on a lot of things. So if the company has liquid assets or the company has other things, then you can pay out a lot of different ways, you know.
Okay.
it depends on what the financial situation of the company is and how these guys have been, this two people have been paying themselves. Does that make sense? So, the key here is that husband's not gonna have ownership. He's gonna, you might get the assets one way or another, but no ownership, no right to run the company, which is what you don't want. Yes.
That's, from what I'm understanding, how could the husband be entitled to 50% of that company, just by marriage? If the company was worth 100% and each party had 50%, how would, your marriage entitle the other party to half of that, 50% that party owns in the company? Would they have to grow from a certain point, when they have to grow, and then the husband would be entitled to the part that he was involved when the company grew?
Okay.
Oh, you understand what I'm saying?
Yeah, you only get ownership in one of two ways, and from that, if you're husband and wife, and let's say you had a company before you got married, right? Okay, so if you have that company before you get married, then you get married, and let's say the company's worth $100,000, then you get married, now it grows to $200,000 in value, and she wants to divorce, or you do, either one, and she leaves. She's only entitled to $50,000 because it grew another $100,000 while you were married. She only gets the growth.
Right, that's what
During
I'm
the
saying,
marriage.
that's what I'm saying. If the company doesn't grow while they're married, then would the
Well, if it doesn't, oh, yeah.
leaving party, would they
No,
be
if
entitled to
there's-
any money?
If there's no, well, it depends on when we formed these two formed the company. Is she forming, okay, let's say this is you, and let's say she getting married now, but the company already exists, right?
Oh, you just, a scenario?
Yeah, I'm
Because
asking,
it's the opposite.
You're
If
gonna-
my partner is a male,
okay,
and he's got married.
okay, and he got married, but you already have the company first.
We already have.
Okay, so let's do two scenarios. So the one scenario is, and I don't wanna get too deep in this, we've got some other stuff to cover, but the one scenario is that we'll just stick with who we've got here, but you had these two partners, and they had a company before anybody was married, right? And then this partner gets married, right? And then they're married for a little while and they get divorced. If the company's gone up in value, he's entitled to 1/2 of the value that it went up, okay? But if the company didn't go up in value, he isn't entitled to anything that doesn't exist, because there's no profit there, there's no gains.
And that's just profit, not ownership, just like a one-time payout, right?
Right.
Okay.
Yeah, so what we're trying to do is separate ownership here, and that's why you wanna have that spousal consent sign off. You wanna have these in your agreements if you're gonna partner with someone and your spouse, so that your partner can keep running the company. If something happens to you, or that the two of you can keep running the company, so that, and your spouse isn't gonna step in. So, let's run through this as somebody passing away scenario too, because this is kind of important. And I'll get rid of some of my chicken scratch here, pardon me. Okay, so, let's say that you've got, same scenario, you've got partners, so the two women are partnered, sorry, I messed up your original scenario there. So, we've got the two gals that are partnered, they own a business, it's worth about $100,000, right? And let's just say that she was always married to husband, like they started the business and she's always been married to husband, okay? And then husband's there, but let's say that she passes away. Okay, so ideally, what do you want to happen here?
So let's go back to the original part.
Right, you really want this partner to end up with 100%, don't you? Right, because they know how to run the business, husband's been out doing something completely different, we don't know what, but he's been doing something different, she's now gone, but he doesn't know how to run the business, and you didn't sign up to be in business with him, did you? Right? I mean, that's just, whoever you sign up to be a partner with is the person you wanna be a partner with. Okay, so you don't want new and sudden partners, you also wouldn't want, like, what if she wasn't married and she passes away and all of a sudden you're in business with her sister or mom or whoever she left her estate to, right? That, you don't want that either, is that correct?
Correct.
Okay, so these are part of the things I want you to start thinking about, a little bit about who do you want your business to go to and why? You know, who do you want to run this business when you're not around? Who do you want to run this business if you're disabled? So 1 in 4 people will be disabled for 6 months or longer. And I mean seriously disabled. I'm talking about they qualify for disability, like you probably won't be able to run your business during that time period. That's a lot, really high odds. So these are things to start thinking about planning, especially as, you know, being the sole business owner, you need some sort of backup plan. That's part of what we're talking about today on this. But anyway, so let's go back to the scenario. So she passes away, husband doesn't want to be in business with her. How do we get it so that this person has 100%, but husband isn't out valued? Any ideas? You sign an agreement, that's right. But the other thing you can do is life insurance. So the company is gonna have life insurance on both of these partners, okay? And what's gonna happen is when she passes away, the life insurance pays out to the company, and then the company pays husband his 50%, and she ends up 100% owner. So she doesn't get the life insurance, but she gets the company, he gets the money. Did I lose anyone? Okay, does that help? Okay, so, yes.
Okay. I understand what you're saying about the life insurance paying out directly to the company and then the company paying out to the
Owns the
husband.
life insurance policy and pays for those life insurance policies on
The
the partners.
company does?
Yes.
Okay. Would it be unusual for the wife to have life insurance on herself outside of the
No, that's fine, totally
Okay.
separate.
That's
issue.
totally separate, okay.
Totally separate issue, yeah.
Okay, this just protects the assets of the company.
Right, well, this allows the partner to keep the company and give the husband what he's due in value.
Okay, I got you.
See, so he doesn't lose his wife and half the value of the company at the same time,
Okay.
right? That wouldn't be nice.
Gotcha.
Okay, that wouldn't be nice at all. Then he'd really know what she thought, right? No, I'm just kidding. Okay, is everybody with me? Yes.
Yeah, just one more question, that
Sure.
spousal consent agreement,
Yes.
is that something that you partners agree on, and, or is it a document that's, you know, I mean, I don't know how to say it exactly, but is there a specific document that's in place already that they sign?
It's a document that's in the management agreement or shareholder agreement. So if you're an LLC or a sole proprietorship and you have partners, you're gonna need a management agreement or operations agreement. If you're a C corp, you're gonna need a shareholder agreement, okay? So even S corp, you can do a shareholder agreement, but we do what we call like non-certificate insurance. You can do shareholder, but they're very similar, except that there's different liabilities and different issues with the company. But in this regard, there's that consent form that you sign off on, okay? And then, yes.
Okay, if you are in business and you end up dating, it's kind of scary speaking about this because it just shows me that you have to date kind of wisely because you end up dating somebody, you don't think that you're gonna move in or they're gonna move in, and you end up dating them, and 6 months later they're entitled to all your 10 years of work. So what advice? I know you can't give advice as an attorney for free with that, but what advice could you give people who are maybe have to encounter that situation to what to do when you're dating?
Okay, if you're dating somebody, you're fine. If you move in with somebody and you live with them, what do I have on here? I've got 6 months, right? And you have some sort of any kind of shared expenses. Usually they're looking for like a bank account or something like that. Or if they're paying into your business, like say they bought you a computer and they they gave you $1,000 so you could go do advertising in your business, and they can track those funds, right? Or in a house, like if anybody in here in real estate, doing houses, you're in real estate?
I have
Okay.
license.
Well, there you go. Okay, so if they've been putting money into your rental houses for you and things like that, or a house you're living in together, they've been fixing it up, putting a roof on it for you and stuff. Now you commingle value and assets and things, and you also have to have somewhat be holding out to, other people that you're acting like a married couple, you know, so, but that's kind of the test, basically. And then they can turn around and claim a portion up, but they can't go back and claim, like, if you had your business for 10 years before you met them, they can't do that. They can only claim if there was growth in the business during the time they were with you, and they can prove these other things. Does that make sense? And then you can have a cohabitation agreement with this person. So, people that are getting married can do prenuptials, which happen before you get married, say, this is mine, it will never be yours, you know, or only be yours after 10 years of marriage, or whatever you wanna do. You can do anything you want in a prenuptial agreement, okay? People that are coming together, and they're married, and one person says, you know what, I forgot, I'm about ready to inherit $1 million, and I wanna start this business, and you have nothing to do with this idea, so let's have a prenuptial agreement, or, I'm sorry, a postnuptial agreement. You can do so you can still do the same thing you would have done as a postnuptial agreement if you can get them to do it now. Good luck, but you know they might. And then you can have cohabitation agreements for those of you that are concerned about common law marriage falling into your realm and where you are in your situation. Okay, so you can say, no, the business is mine. It's always be mine, no matter what, or it's mine till I die, and then you can have it, or whatever, you know, you can structure things a lot of different ways. Does that make sense? Okay, so you have choices, and it's not gonna cramp your lifestyle, because you just need a reason, right? That's always helpful. Okay, so we covered divorce, we covered living together, right? We covered the growth and the value of the business. Okay, we covered prenuptial, postnuptial, cohabitation agreements. All right, dissolution. So dissolution can mean a lot of things. It can mean bankruptcy, it can mean selling your business, it can mean selling assets out of your business, it can mean a lot of different ways of dissolving the business. So is anyone familiar with the different types of bankruptcy? You know the answer?
Yes.
7, I heard 7,
Seven.
yep, okay.
7, 11, 13.
11, 13, right, and 7 is like, that's when you're restructuring, and 11 is when you say, I'm finished, right? Okay, so you don't come back from that. I don't wanna get into too many, I'm sorry. You should be an attorney, not a paralegal.
Well,
You're
one
very
day.
knowledgeable.
One day, however.
Yeah,
It's not, if it was free, I would have been an attorney.
understood, yeah, it wasn't free. And some days it's still not. All right, so that's where we are. Okay, so what's the very first thing you want to do when you're deciding that you're going to either sell your business, close your business, or sell the assets out of your business?
What's the value?
Right, you have to know what it's worth, right? Like, you can't go post your car for sale somewhere and say, oh, I think it's worth 20 or 30,000. Everybody's gonna look at you like, what do you mean you think it's worth 20 or 30? What's the car worth? Right? Okay, and you wouldn't buy something like that either, you have to know. So valuation becomes the most important thing in your business, basically, when you're gonna do this. And also, it becomes important at death, and becomes important at divorce, because you have to know what the value is at any one of those points. So you can move the assets around as needed. Okay. So why would you sell the assets out of your business instead of selling the business itself? Why do you think someone would want to buy the assets out of your business instead of selling the business yourself? Selling the entity? Yes.
If the business isn't viable, maybe?
Right.
Or if it's not, if it's a business model that just doesn't work, but the assets still work something.
Right, yep, so there might be something valuable in there. What are some business assets, guys? Help me out here, let's get rid of our family folks problems up here, family issues, right? Our dysfunctional family, they need to go. Okay, so what are they? Talk to me.
Equipment?
Equipment,
Okay, equipment, right? What else?
real estate.
Okay. What else?
What about accounts, payable?
Accounts
mean, not-
payable,
receivable,
right? Accounts
receivable.
receivable, AR, that's right, AR. What else, yeah,
Building?
could be a building, that'd be real estate,
Oh,
right?
yeah.
How about contracts? You could have contracts with other companies, right? That are valuable. Things like licensing agreements, you may have the rights to use a name, to use software. How about intellectual property, right? IP? Intellectual property is like, coding or information, or it's, or something that you know that no one else knows, it has to do with a lot of different things like that, right? How about the name of your company? Do you think the name Coca-Cola is a really valuable name? Do you think someone would pay $1 billion to own that name? Sure they would, right. So how about goodwill? And I'm not talking about going to get things for cheap. What's goodwill?
What the company's done in the community to kind of garnish favor or support, like
Okay.
their good name.
It's more important than that. That's a good thing. That is positive, like a reputation, integrity, and how well known you are. But goodwill is more like if, let's say, I own a Massage Envy, okay? All my clients and how many times that they tend to come back, that's part of my goodwill, my customer list and contacts like that, just for the business, the client list. That's really valuable. And what they think of that business is really valuable, right? Because without those clients, I could sit there massaging me, twiddle my thumbs all day. Okay, so that's your goodwill. It's hard to value goodwill. It's easier to value it in like a service industry, like a doctor or a dentist or a massage therapist. It's easier to value it there because you can see the consistent thing. It's harder to value it in something like manufacturing maybe, except for like orders based on continuing customers or something like that. Does that make sense? Okay. So those are all assets of the business. Who's gonna buy a business in here? Anybody gonna buy a business? Buy a portion of it? You're gonna buy a portion of a business? Okay. Here, why do you think you would wanna buy the assets of the business from the other person instead of the business, the entity, the LLC, the S corp, or the C corp?
It's a sole proprietorship right now.
Okay, well, it's a sole proprietorship, so you're still just gonna buy the assets in this case, but,
Yeah.
okay. Well, why do you think you guys would wanna buy the assets and not an entity?
Why would I buy the assets and not the entity?
Yeah.
Well, I'm buying part of the entity also.
Okay, but normally you wouldn't. Here, I'll explain why. And this is gonna happen to you too, if you ever sell your business. If they're savvy, they're gonna say, I don't want to buy the entity, I want you to close the entity down, basically, and I'm gonna buy all the assets out of the entity from you. And they're gonna do it because they don't want the liability. So if you have any unknown possible lawsuits, which, contract lawsuits could show up for like 4 years, other types show up for like 2 years, then you've got an issue outstanding that may come and bite them. Even if you have a perfectly clean record and it looks good, most companies, small and medium-sized companies, are gonna wanna buy the assets from your company, take it over, absorb it, and put it into their company, whatever that is, client lists and all these different things, instead of buying your entity, okay? And vice versa, so if you ever wanna go buy a company to grow, be careful, go buy the assets, but remember, you don't wanna buy liability. And so when people sue, they're gonna sue the entity. Okay? Does that make sense to everyone? Okay. On that, alright. Closing your business, so basically we have the Texas Business Organization Code for that, and you've got, issues with creditors. You have to follow very specific rules with your creditors, with how you're gonna close it down. Franchise board, everybody, if you have an actual entity, you have sole proprietorship, it's not as big a deal, on that, but they'll make you close things out. If you've got pending lawsuits and you try to close out, or you know someone's gonna sue you soon and you try to close your business and pull all the assets out of it, they'll come after you personally for fraud. Just so you know, you can't do that kind of thing, you can't, play with it, basically. The same thing with bankruptcy, you can't start pulling a bunch of money out to pay your car off or something right before you claim bankruptcy in your business, okay? Here's the other thing I want you to watch. How many of you are signing for loans right now, or any kind of credit for your business? Anybody? Loans, credit, okay. We all do this, right? You have to, at some point, you're gonna need a little money to give your business the next level, to boost, to advertising, whatever you're doing, right? To grow it, something like the equipment, you're gonna need something. And what are they gonna say to you when you go there? You have to sign guarantee personally in a contract, right? Because you owe me money, whoever they are, or the bank, right? Okay, so what that does to you is that makes you personally liable. That has just pushed your entity out of the way. Normally, somebody, if they're gonna sue you, they'll sue your entity, you know, for a bad product or something like that. But in this case, you've just negated it. You've pushed it to the side and you're gonna ignore it completely. And you're saying, I will be financially liable for this $5,000 or $10,000, whatever it is, or this lease that I just signed so I could lease space for a year or 5 years. And now they can say, okay, it's too bad your company went bankrupt. It's too bad that you sold your assets or you closed your business. You still owe me. You're stuck with that. Does that make sense? So now you're looking at personal financial issues. So the goal here is to move away from that, and you get it so that your company can actually sign for your loans, sign for your leases, and you don't have to have personal guarantees. But that takes time, and it takes knowledge, and it takes basically having a financial track record to get there before you can get to that point. But that's the goal, because then if you ever have a problem, somebody sues you, you get a bad batch of something, whatever you're doing, and it goes, wrong, and you need to close the business or claim bankruptcy, you can close down all those creditors through the company, and it doesn't hurt your personal credit. But for now, most things are gonna be on your personal credit. But just remember, as you move along, you grow, try to get that stuff on the business and not you, okay? Stay on your personal credit. All right. Okay. Let's cover some disillusion and gifting issues, things like that. Actually, I wanna sort of come back to that. Let's do disability real quick. Okay, so 1 in 4 people will be disabled at some point in their lives, right? For more than 6 months. That's considered a long-term disability when you're over 6 months, unless they change the laws. And you're not here to talk about insurance today, are you? Okay.
No.
Just say, if you know something I don't know, speak up. Okay, so there's different types of long-term and short-term insurance that you can get, disability insurance. I highly encourage you to do this. You're not gonna be eligible until you've been around, your business has been around for a year and you have a track record, you can show what you were making and how much is there. So it may take a couple of years to actually qualify if you've been running negative numbers in the company. But once you do, it's very important that you get this insurance, especially when you're still in that small business stage financially. Because if something does happen to you and you are sick for 6 months and you can't run your company full-time, or you can't run your company, you wanna at least be able to have the finances flowing in to cover some of those things, right? Whatever they are. You may have a lease, you may have a debt that you owe on something. You may need the income out of the company for you to live on for a while. A lot of different things. So make sure that you look into this and talk to your insurance agent for it. Short-term disability is under 6 months, long-term is over 6 months. And you can even get insurance, like if you have a lease, which will just cover your fixed costs. Let's say you have a lease and you have 1 employee. It'll cover your fixed costs during that time. There's a different type of insurance also. Think about who you're gonna have run your company. This is really important. You need someone who can cover for you. Life happens. really, really it does. So find one person that can step in for a while, or two people, you know, if you can, at least two, or two people that can split their time and do it for you. Something that can cover it for you, because something can happen to you for a while. And get your financial power of attorney drawn up. That document is gold for you and your company to make sure that you have a financial power of attorney, so that person can pay the bills, so that they can cover all the things that you need, and they can make decisions. They're not handicapped, you know, cause you can't, if you just come to me and you say, well, take over my business, right? And I say, well, okay, and then I go to the bank and say, okay, I need to cash checks, I need to pay these vendors and this and that, and they say no. So get the financial power of attorney in place as well for yourself, right now, okay. Alright, who are you gonna leave your business to? Who you wanna leave your business to eventually? You're building it for your kids? You gonna leave it to your spouse, partner, employees? Who do you wanna leave it to? Hello? Who do you wanna leave it to? Husband, dad? Who?
My sister.
Your sister, okay. How about you?
Nobody, actually, not right now.
Okay,
I'm
alright,
not married, don't have any kids. I
right.
think my mother has her own property, her own business.
Yeah, understood, and as my mother did too, yes. That's where I got the entrepreneurial spirit. My mom and my grandma, both of them were, yeah, so, nice. And how about you?
I haven't thought about it, but it'll probably be somebody in my family.
Okay, okay. We, guys need to start thinking about that, who do you wanna leave to? You can even leave it to a charity, did you know that? You could leave your assets and your business to a charity if you want, it's possible. Alright,
I've already started, turning over my business to my son.
yeah,
One of them at least, and then him get his feet wet and teaching him the business and how to run the business, while I'm still here.
right,
I don't
right.
wanna, cause I've seen,
Yeah.
I've seen so many businesses and properties and real estate, so much stuff, just wasted away because of the lack of, paperwork, legal documentation.
Right.
And people, I've seen people who were millionaires that had a lot of stuff and it didn't go to the people that
They wanted
they
to,
wanted it to.
right, it falls apart, that's exactly right. So, start thinking about not just your business, but also your personal. I mean, I know this is like business succession planning tonight, but succession planning is also your rest of your assets and your personal, and everybody has assets. I don't care how few assets you think you have, you really do have assets in the state of Texas, and you will end up in probate. So I have a friend that always says, if you don't have a will, then you don't have a plan, and the state of Texas will have one for you. And that is probate, and it's time consuming and expensive, and cause your relatives and the people you care about a lot of heartache and headache to deal with afterwards. Yes.
What about when you have a will and then it's challenged and, the assets still, I mean, the assets get taken by the attorney fees and stuff. You know, I've seen that too.
Yeah.
Just having a will doesn't do it.
Not always, you're right.
It doesn't, you know, you gotta have something. I don't know what it takes. Matter of fact, I'm throwing that at you. What does it take?
It takes a few things, so it depends on that. Let me get through this part and we'll come back to that, because it's a very good point, okay? So, for your business, you're gonna wanna have the spousal agreement in there if you're married, or if you're cohabitating with someone that looks like you're gonna have the issue of that, okay? So we covered that earlier. You're also going to wanna have a shareholder agreement as if you have an S corp or a C corp, and divide things up in there differently also, okay? And then you're gonna wanna, if you do pass away and something happens, you're gonna need a will, and you're gonna need financial power of attorney. Definitely, those are on the business side, that you're gonna need the will and the financial power of attorney. Okay, and hopefully you did the life insurance thing for the business that we had up here earlier, if you have a spouse, so that your partner or someone can keep it, or if it just goes to your spouse, you don't need that. You're not even gonna need the company to own the life insurance, you can just leave it to your spouse or whoever you're leaving it to directly. That's only in a partnership type situation. situation that you really need that. Does that make sense? Or if you have employees, anybody have employees? Do you have employees? Do you have employees? Do you have what you call like key employees, people that, if you didn't have that person there, the business wouldn't work right? Okay, so you may have what they call key man insurance on that person, so if something happens to that person, the business will have life insurance on them, and you can cover the expenses of whatever happens, plus trying to bring in someone to replace them, okay? And that, so the company will own the life insurance on that person, or you can use that to buy out shares if you're at a C Corp or something like that. Remember the story about Walmart owning life insurance on their employees, even if they weren't key man? Does anyone remember that at all? It was a while back, yeah, okay, well, we won't get into that. So, okay, so if you are, for your personal side, there's a list of documents here. So medical power of attorney, living will, director of physicians, HIPAA releases, declaration of guardianship, the will memorandum of director for disposition of remains, or a trust. Okay, so if you have a lot of assets, or you have assets that are other than your house, so in this instance, you're all business owners. If the business grows, you're probably gonna wanna consider a trust and not just a will. Because as the value of that business grows, the needs change regarding what you need. So a will just says, I leave everything to everybody, but a will is what I call a catch-all document in Texas. So it's what keeps you out of probate, so you don't miss anything, okay? The trust is where the real asset, so things out, you can't put your house in it. People do put their houses in, I'm hearing that you should if you have a trust, but, so they put their house in there, they put their business in there, and they put their other investment type things in there as well, okay, that are outside. And then they move those and they direct them, how they're gonna direct them. And this is what's gonna keep you out of probate, and make sure that it's specifically directed to go to who you want it to, when and how, is the trust piece, okay? Now, there are things you can move around outside of your will and outside of your trust, okay? So those would be bank accounts, not your business bank account, but it would be your bank accounts. So you can do a POD, pay on death, if you want, or joint rights with survivorship on your bank account. You can, your IRAs, your 401ks, all of your retirement accounts like that, they can all be moved directly to somebody if you wanna leave it to them. And if you put directives on there, those will go, no matter what your will says, those will actually override. Your beneficiary documentation on your IRAs, life insurance, bank accounts, anything like that, you fill out separate beneficiary documents on, and you send them over, those are gonna pass your will. So let's say you made a will recently, and you forgot to go change your beneficiary designations on all these accounts. If you left it to your ex-husband and you pass away, he's still the beneficiary in all those accounts. Doesn't matter that your will says, I want this to go to my sister or my brother, it's gonna go to your ex-husband. It's gonna ignore your will. Those override wills in Texas. Yeah, so that's something to think about. If you did beneficiary designations on anything, go back and double check them all and make sure they're up to date. Your will is a catch-all, your trust is really the directive of things. Any question on what the other documents are for your personal? On here? Did I lose anybody in this process? Lost you. You have a question?
I mean, I would have too many questions, it's kind of going back to learn your ABCs first, and then you
It's a
can kind of
lot.
keep up with your conversation.
Right.
But, I think I did wanna ask, how much does all this stuff cost? Like, a lot of people probably don't have wills or have all this stuff because they may not have the money to pay for it. Is it expensive? Cause it looks like a long list of stuff that a business may need, like if you had to put in a dollar amount to just invest in yourself and your business, how much would it cost you to go to an attorney and say, I need all this, I need this,
Right.
protect yourself?
This conversation is more about, I just want you to start thinking about these things
Okay.
for your succession, both for your personal and your business, okay? It's not that you have to go do it right now, but I just want you to start thinking about it. Who's gonna run the business if I'm disabled? Who am I gonna leave my business to? Who am I going to leave my assets to? How am I gonna structure this? What does it look like for me and my family, right? If you have children, what if you have underage children? How many people in here have underage children under the age of 18? Okay, quite a few of you. You can't just leave them the business and all the assets if they're under 18. You have to actually, if you don't go and make a trust for them and appoint a trustee and a guardian, then the court will do it, and it costs a fortune. And they're gonna try to pull that out of your estate afterwards. So it's less expensive and less headache for it to be done now, especially if you have underage children, to direct those things. And you decide where they're going. So, like a standard will and things like that, you can probably find an attorney to do it between $600 and $800 with the documents that are listed in a standard will. Do not go to LegalZoom. They actually are missing language that's required in Texas. It'll still throw you in probate and things like that. So don't go online and do your will. You either handwrite your entire will, you know, but then you're gonna be missing all the other documents here which are important, or you need to go to an attorney and save up and pay to have it done, basically, and get it done right. Some of these other things you actually should know about what they are. They're important. So medical power of attorney. So that basically gives somebody the ability to direct what's going to happen to you and look at all of your documents if you're not conscious. Living will or directive to physicians. That tells people, do I want to be on life support or not? And if so, for how long, and what does that look like for me, okay? That's important. Without these two things, only the doctors are gonna be making the decisions for you, and they don't know you. And they will try to keep you alive in whatever condition you're in for as long as possible, period. You know, and you may or may not want that. You may not be able to handle that financially too. There's a lot of things to consider. HIPAA releases are the federal laws. And even husbands and wives now, under the federal laws, cannot see each other's medical information or records unless you have a HIPAA release. Even if you're out cold, okay? Declaration of guardianship, that is saying who's gonna take care of you if you can't take care of yourself, who's gonna take care of your well-being. Let's say you're mentally incapacitated for 6 months and someone needs to take care of you. You probably wanna decide who that's gonna be in advance instead of letting your family decide, right? Because if I know my family, they'd squabble for a year, and I'd probably end up in the corner somewhere. So, all right, will memorandum, that's the little things in the house, jewelry, your grandmother's teacups, your favorite painting, stuff like that. That's what you use the will memorandum for. Those are specific bequests under the will. All right, and directive or disposition of remains. That's how are you gonna be buried, what's gonna happen to you, and when do you want it to happen? Do you want pink roses, red roses, no roses, all of that, okay? And then the trust, and we talked about the trust earlier. That's where you're either gonna take care of people you wanna leave things to specifically, you put your businesses in, you put your house in, you put things like that in, right? Is everyone clear on this?
So who owns the trust?
The trust is gonna be owned technically by the beneficiaries, but the trustee will run it. So let's say you have minor children, you'd wanna leave things in trust, so the trustee would run it and then give it to them later.
And who appointed the trustee?
You did,
Okay.
yeah, you're gonna ask for the trustees that you want on there, yeah. And you can choose like a professional company, like a bank if you want, that handles that kind of thing, if you don't trust anybody, you know, in your family or whatever. So you have a lot of options on that. Okay, we talked about life insurance, right? And we talked about, let's just cover this, sweat equity. Anyone dealing with sweat equity issues in here? You guys know what sweat equity is? Okay.
Yeah, a lot of that.
Somebody doesn't have money and they work to get ownership in the company, right? Yeah, it's kinda like you're doing your son, right? And it's family limited, but you could do yours in a family limited partnership. You can move things over. You can move over up to $16,000 a year in value, or right now, there's a $5 million cap. So you can use up what they call your credit, up to 5 million and move assets over to your son too, without incurring the gifting taxes on that, okay? Just to give you a little bit of a
You
heads
say
up on that.
16,000 a year.
Or up to
Oh, okay.
5 million right now in value. But you'll be, if you do over 16,000 a year, you're gonna start using up your ability to leave money to people later above that amount without having to pay taxes on it, okay? Okay, just to let you know on that. Anyone have questions? We got 3 minutes or 2 minutes. Did I overwhelm you? You guys looked overwhelmed. Are you in a pizza coma? Anything? No?
So we're not dating.
Never living with anyone. Never dating anyone. Okay, well, here's my personal thing that I'm gonna do. I wanna see you succeed. My grandmother had her own business, my grandfather, my mother, and she was a single mom. And I started businesses at young ages, and I wanna support you, and I wanna see you do well. So what I'm offering is 1 hour of free consultation to all of you as my volunteer work. And if you wanna call me and ask me questions about the type of entity you should have, or anything that you should be doing, or documents you need, or you just, I'm not sure about this or that, call me. This is my personal cell phone number, okay?
No drunk dialing, please.
No, yeah, please don't do that. Don't stalk me, I'm armed.
Everybody give Terry a hand, please. Yeah.
Another thing, these are really good books. They're called NOLO. These are really good basic books for running your business and making sure you have a lot of the stuff that you need to get started, okay? So go online and get these NOLO. They're awesome. I'll leave them in the back on this table for a little bit if you guys wanna look at them.
All right.
Okay, thanks
So
guys.
much, Terry. Come up and present. So please give him your undivided attention. He's gonna talk about business growth and some other topics that you guys definitely will be able to utilize in your business world. So please give it up for Brandon Harris for Capital One. Yeah.
No, I'm really with the IRS, so. Got my address if you wanna mail your checks.
I think everyone's looking for you right now, your money.
You know, they got a scam going around with that.
They do,
You better
yeah.
Be careful.
Which one? I think that I'm an astronaut in space and I have $10 million. If you send me $1 million, I'll give it to you later. Just a second, guys, sorry. My car is about to get.
Okay. That's good.
At the basketball games? Oh, the chemical stuff that goes on?
Okay.
Oh.
Sorry, guys, I was about to preface that by saying that I had to get my car towed, so
I don't know what that.
they called me right then. Anyway, y'all already covered succession planning, so we get to skip that part. I know y'all loved it so much, so we're just gonna move on past that. But I've been with the bank now for 3 years, going on the 4th year. Before that, I was at Compass and Chase, kind of doing the same thing, starting from the small businesses up to the larger businesses. And I have a small business myself, so I understand what all of y'all go through, and how hard it is to start and find money and just kind of make it work, especially if you do it on the side. So I kind of have a little understanding of what everyone has to do here. But today we're going to talk about how to fund your business growth, not by where you're going to get the loan. I know you already met with some lenders, in the past week, but more of, what does a bank look at so that you can prepare yourself, that you want to grow your business and you're prepared to get it approved instead of just, a shot in the dark. I'd rather prepare you guys to let yourself grow and not have any surprises when you go to a banker. And then preparing for disaster. Unfortunately, disaster happens, and what will happen to your business if that happens? So we've got to kind of, plan for that. And the succession planning is what we'll skip. But anyway, we'll go ahead and get started now. So you just should space bar. Yeah. So the growth and financing option, the types and key aspects of debt financing.
So keys to get that successful borrowing that I just mentioned?
We'll talk about creditworthiness. Ratios, I know everyone loves math. And then your continuity and disaster planning. So when you're talking about business growth, you kind of want to not just know about the growth that's out there for all businesses, but you want to specifically learn about how is the growth options for yourself, for your business. You know, the lending or debt needs of a restaurant are much different than that of, you know, a manufacturer or a service industry. You know, it can all be very different. You also want to talk about evaluating your creditworthiness. So it's not only about your actual credit. So everyone thinks it's only about your credit score, and it is not. It's actually 5 things. So we'll talk about that. And then the key ratios that we talked about, you can learn those at the end of this. And then preparing for disasters. And this is the growth and financing options. So this is just an SBA chart. It's a little old. Sorry, the SBA doesn't update us as quickly as they used to. But you can kind of see here during the growth just of what SBA lending levels did. So they went up from, you know, under 20 million to under 20 billion to over 30 billion just in a 2-year period. So that was like a large time of growth, and we're in that same kind of growth right now. And thankfully the SBA is there to help you guys, especially small business. That's kind of what they're for. They're not just, even though they're called Small Business Administration, doesn't also mean that your business grows beyond a point in your mind that you think that, you know, they're done with you. Small business, from a government standpoint, actually goes up to $5 million. So it's a big difference than in your, you know, in what I think is a small business, because my business in my mind is not really $5 million a year. Then we'll go on to the next. And then you can see here, this is kind of a little bit of data that they had about it. This is basically a survey, actually, is really what it is. They're just telling you about, you know, what percentages of businesses were ready to increase their spending. And you can see that as the economy is improving, people are increasing their spending, hiring more employees, and then their finances are continuing to improve. So it's just like the same thing that we're in right now. We're in a growth phase. So everyone that you see is expanding. I'm sure if y'all have been around DFW lately, you'll see construction on every corner. That's a good news for everyone, right? I mean, it doesn't matter what business y'all are doing. The more people that we have as consumers to sell to, the better you're going to do. So then we talk about the demands of cash. So it's your working capital needs. So it's, you want to have enough funds to, you know, fund your daily bills and monthly bills. And then your expansion of your facilities and equipment if you have any. And then your workforce. So, you know, people actually are normally the most expensive thing. Especially for a small business, salaries is usually the #1 expense. So you got to be able to manage that. And the way to do that in a lot of ways is going to be like a line of credit or some other financing that I'll talk about. So you got business growth funded by your operating cash flow. Now, if anyone in here has a business with a 90% margin, you know, raise your hand, and we all want to learn from you. But most people have a lot smaller margin. And in order to operate by cash flow alone, especially in the beginning, is completely impossible. So the way that you can grow it is out an external source of capital, whether that be from the different funding sources that you guys learned about, or whether it be from a bank traditionally. So you got the debt financing. So this is what we're talking about, is talking to a bank. So that is going through me or another small bank in the area of wherever you're at. The kind of the benefits of it is that your ownership is never diluted. I know she probably talked about ownership of your business. Ownership of your business, especially when it's small, is worth even more, because as you grow and the annual sales of your business grow, you might have given away too much of your business early on. I'm sure some of y'all have seen Shark Tank, where they take everyone's money.
Yeah.
That's really what they're doing. Cost of capital, though, at a bank is a lot lower than the other methods that y'all probably learned about. Interest rates will be different, but at a bank it might be more right now around 4 or 5%, something like that. So, you know, some of those other sources, even though that they can help you earlier than a bank can, might be in the, you know, teens and 20% range. So that can really eat into any profits you're making, and 20% is going right back out the door. And then equity financing. So this is exactly what we just talked about. This is Shark Tank. This is the angel investors, they like to call them. I don't know if y'all met with one yet, but I don't really call them angels. They're more like the devil. So they go in there, they find out that your business is doing great, and you know they want to take a piece of it. It's not that something that in certain instances where it's a good idea for you, you have to do it. It's to get you to the next level. And you know, when you've seen probably some success stories on Shark Tank that were that exact scenario where they didn't really do so good, they let one of the sharks take 20%, and now they're 10 times bigger. But you know, that's really not, you know, an accurate picture of all the deals that are happening out there. I mean, Shark Tank is a TV show. You know, there's a lot of investors, especially in Dallas, with all the growth that we're having, and you know, the deals that people might get are not as good. So they might be taking more like 51%, and when you give up 51%, we all know what happens there. So big difference. All right, then this is the aspects of the debt financing. So we'll kind of go over that. So you, on the bank, you got a line of credit, which is what I talked about. That's for your cash flow. So you know, managing your daily bills, your payroll, monthly expenses, things like that. It should be able to be repaid within 12 months. So if it's some asset, and that what I mean by that is you're trying to buy some equipment, you're trying to buy a truck, whatever. Let's say you have a $50,000 line of credit, the van, whatever it is, $5,000, $10,000. Don't ever use a line of credit for that. You shouldn't even do it if you think you can pay it back in like 6 months, because if something happens, all of a sudden it's sitting on your line of credit, and now your line of credit, which is supposed to be used to help do your payroll and expenses, has no availability, and now you put yourself in a bad situation. And when you go to the bank and try to explain to them what happened, they're not going to be very happy, because you told them that this was going to be used for operating capital. And last time I checked, that like a vehicle is not operating capital. So just keep that in mind, when y'all get set up for financing. Do it the responsible way, and the banker and the bank will always take care of you and increase it as you grow. And then you've got term debt. So that's exactly what you should have done in that scenario, is actually go to your banker or whatever it is and get a loan for that vehicle, usually a couple of years. If you pay it off early, it's great. I mean, usually loans for that size don't even have a prepayment penalty. So if you think you can pay it off in 6 months, that's fine, but amortize it over a couple of years, giving you low payments, it's just a little bit more manageable. And then you've got leasing. Not everyone does that. That's something you need to talk to a CPA about to get exact if you should do it or not. But you can lease, all kinds of things. People think that you can only lease cars. No, you can lease equipment, you can lease computers, you can lease everything. And leases work different. It doesn't necessarily mean that at the end of it you give it back to somebody. There's leases where at the end of it you pay $1 and you own it. So there's different types, and again, that's the CPA question to figure out what you might want to do. And then the interest rate management that we help with, that's kind of where we're talking about, let's say you're funding a lot of your growth on a credit card. Well, if you cannot pay it back every month, that interest rate is a lot higher than a line of credit is going to be. It's also, you don't want to go buy equipment that's going to take you a long time to pay off on a credit card. Because again, the credit card is just like a line of credit. It's meant that you should be able to repay it quickly. And again, it's a line of credit, so it's needed as needed over the term. So that means that we give you $50,000. You don't come to me every week and say I need to borrow $1,000 or $500. You just do what you want. We usually, on smaller amounts, they just stay open up to $250,000, and we don't do anything. You just do whatever you want. As long as you pay us back on time and do it properly, like I talked about, it's just going to keep continuing, and as you grow, we'll increase it. Variable interest rates, though, are charged on those. This is the main reason you need to make sure that it's a short-term expense. Because as the interest rates rise, as you already know, they went up 0.25% recently. That cost of funds that you thought was a fixed amount for your truck that you bought is now a 1/4 point higher, and a 1/4 point higher, and it's going to get higher and higher. That's exactly what would happen, You're expecting to pay a $300 a month payment, next thing you know, it's $600 a month. And that's really the reason that you always wanna have your assets that are larger on a loan. Okay. And this is the term debt again. So most of the term debt, and especially the ones that we do here at Capital One, are fixed. So that means that the interest rate doesn't, change over the whole entire term of the loan. Even when we look at real estate, most of what Capital One does is a fixed rate interest. A lot of small banks you'll see will give you what's called a 515. It means that your interest rate is set for 5 years, amortized over 15, and every 5 years it changes. So if the markets are going up and the interest rates are rising, every 5 years you might get a big surprise, all of a sudden that your loan payment just went up by double. I mean, you never know. So be wary of that. I mean, if another term for that is an ARM, which probably some of you have heard about. It's one of those things that looks good up front and isn't really good at the end, so.
Do they have caps on the salary?
On ARMs?
And the line of credit, on the cap on the?
No. ARMs, some ARMs do. Lines of credit do not. It's the Wall Street Journal rate, which is 3.5 right now, plus a margin. Whatever that margin is, it's fixed. So if the bank offers, 3.5 plus a half, if the margin goes up, the margin will never change, but the rate might go up based on the prime. And then leasing, this is again, where we're talking about different terms. May or may not transfer ownership, that we're talking about a $1 in lease. And this is about upfront investment. So the reason that you can do a lease though, is that you can actually do a lot of them with 100% covered in the purchase. You obviously can't go to a bank and say, give me a loan for 100, everything. No down payment. But on leases, a lot of them will do 100. Some of them will even do 110%. So what that means is you ordered some kind of equipment and it required, expenses to ship it, or someone had to come out and set it up and they charge you a setup fee for whatever it is. So we'll actually cover that too. So it is used in those situations where maybe you don't have as much capital but you need to grow, and that's where a lease comes in. Now a lease isn't set in stone too. It doesn't mean that you can't come to a bank later and say, I want to buy out my lease. And then we give you a term loan and you can buy it out. Yeah.
No, okay, I'm sorry, Ms. McKee.
So successful, so again, you want to talk about the strengths and opportunities, weaknesses and challenges in the current financial situation. So this is what we'll be talking about in this area. So we'll talk about your needs and objectives. So again, it's just like what I talked about. Someone shouldn't just say, yeah, I'll give you $50,000. They should really understand what your needs are. And you also should come prepared to a banker with what you need. We don't know your business as well as you do. No one does. You can't just go in there and tell us, what do I qualify for? That's not what you should go in there. You should go in there with, this is what my plan is. I need this much money to grow in the next year. And this is exactly what I need. It's not that you can't get a line of credit for X amount. You should get it for what you need for now. Use it properly and increase it as it grows. You shouldn't just go in there and get the largest amount that you can. Again, we're going to look at your immediate and longer term needs. So that's going to be, what is this credit need for? Is it really for operating expenses, or in 6 months from now, are you anticipating some large increase? Or are you needing to buy equipment that might happen? Or do you think that if this contract that you're about to get is signed, and you need to add 5 employees? Like, those are all things you need to think about and share with the banker when you talk to them as well. All right. And again, you want to meet with prospective lenders, and I hate that word, but you need to speak to different banks, not just one. So you don't need to go with, I'm real comfortable with this person. It's not about the interest rate, it's also about the relationship and if they're asking you the right questions. Because again, if they're just trying to give you money without asking anything about your business, it's not really where you need to go. They need to be invested in your business, because a good banker and bank that you go to should want to be there throughout it, throughout as you grow from the small all the way to the large. It's actually more exciting that way anyway. in my opinion. So again, we look at the, your current state and your vision, and then we'll talk about our different loan products and solutions. And then you kind of understand, an independent and balanced assessment of the application. So what we go over as well is the application process. It's never just like sign here and it's over with. There's requirements that we need, no matter if we go to the SBA or through the bank, and those are things that we'll go over as well. It should be up front. And then we want to identify any issues early and see if we can fix those. So, if you tell me, hey, I had a loss last year, or we really did great last year, but the year before was a loss. Well, then we're going to want to get those taxes filed. Let's say it's right now. We're going to want to wait to get your taxes filed to show that year of profitability, because we can show that you're going the right direction. It doesn't necessarily mean that you got to be perfect every year. Especially when you begin a business, you usually have a loss the first year. That's normal. So don't get scared if you don't. Okay? And then again, the application. So this is where we're going to look at the historical financial information, your tax returns, business and personal, and then interim. So this is where we would talk about, yeah, we've got your stuff for last year, but how are you doing this year? Because if you did $2 million last year, and it's already been 2 months this year, and you've done $5,000, something's wrong. So it's not just about trying to get one over, I guess, on the bank. We're there to protect you as well. We want to make sure that what we're letting you borrow or give you access to is something that you can repay. We don't want to go into the chapter of bankruptcies that you mentioned back there. So let's see, maintain open balance. Let's go to the next one. And then this is assessing the credit worthiness. So again, this is not only about credit, so I'll go over that. So lending provides an opportunity to make a relationship with you. So it's not that we don't want to have a relationship already, but a lot of the times when you're meeting a banker, there's two reasons you usually see a banker. You either owe them money or you need to borrow money, right? I mean, how many people go to the bank and just say, hey, how's it going? I mean, nowadays y'all deposit checks on your phone, you go to an ATM, no one ever says hello to me unless something's wrong. So I think it's better to create that relationship with whatever banker that you have, again, so that they can understand your business's long-term growth and be a partner in it. So these are the 5 C's of credit. So like I said, it's not only about actual credit. So the character. So character is another word for credit. Character is how do you pay your bills, both personally and on the business. Just because you're taking care of your business and you're not paying your home loan doesn't mean that we trust you. Because there's 2 things that's going to happen, right? If you're not paying your home loan, then you probably can't pay anything else. Because the number one thing that you're probably going to pay is your home loan. That's just an example, but there's a lot of other options. We look at capacity. So again, this is the business. Does it have the capacity? So you have a business plan. Do your current equipment sufficient? Is delivery well developed? And then when we talk to you about what is your growth plan for the next year, does it make sense? You can't just say I'm going to grow $1 million and not really have a plan to get there. And then conditions. So the economic and market conditions. So right now, we're obviously in a pretty good area, but if you were in the oil field service business or the oil field business, you would say that the condition would be very bad and the bank probably would not want to loan a lot of money to you right now. Especially a majority of the banks in Texas. There's been a lot of oil field companies got out of business lately that you see in the news. And so that would be kind of a specific reason that it wouldn't be good. But luckily for everyone here in DFW, we don't really have any economically bad conditions for probably all of or a majority of your businesses. We're probably in one of the better markets where a condition does not really affect us. And then capital. So basically, if something bad happened, we're going to figure out, does the company right now have sufficient net worth to cover cover itself if something bad happens? So what that means is, let's say you are a restaurant, right? You're running around and the restaurant is doing great. All of a sudden, there is a E. coli outbreak that gets in your lettuce. Well, do you have the funds, and backup needed to sustain some bad, reputational damage like that? Can you move to another location? Can you restart? I know all of y'all probably know about Bluebell. We all love that ice cream. And I'm sure all of you went to the store immediately as soon as it returned. And we all gave a blind eye that they did not care about food safety. So, that tells you the value of a brand is so strong that you don't even care that you might die. I hate to say it, but it's true. No one was worried about what they did wrong. It was about, oh no, when are they going to come back? Yeah. So anyway, that's the kind of capital. In Bluebell's case, they did not have the capital to sustain a loss like that. As you might have noticed, they had a huge investment by the Bass family in Fort Worth. So now a huge owner of them is the Bass family in Fort Worth. I think they own now more like half of Bluebell. So, yeah, they gave them a lot of money. If it wasn't for that, though, Bluebell would not return. Collateral, and then when we're looking at collateral, is the collateral sufficient as a source of repayment? We never want to look at your collateral really as a source of repayment. We're not in the taking business. That's the IRS's job. The bank is more about, we want to loan money and hopefully you can pay it back. We don't want to go, well, what if we liquidate all of your assets, what is all that worth and can't pay us back? Because an example of a restaurant or some other service industry, what is your equipment really worth, at auction? Pennies on the dollar. A bank is not a restaurant. We're just going to go to auction, sell as cheap as we can. It's the same thing if the city of Dallas or something took over something. They're going to sell it as cheap as they can. They're just trying to get rid of it and not worry about it anymore. I'll stop a second on that. Does anybody have questions on the C's of credit? Different things? No? All right. So the sources of repayment, we look at the cash flow from your operations. So that's, can the money coming in afford to pay the money going out? The guarantor support. So not only is the guarantor could be you, but it could be your spouse or your other partner in the business. Do you have a job outside of the business? Well, we use that income and add it in there and look at it as another source of repayment. So if something bad happened, we say, well, they still have their main job bringing in money and they can afford to pay the loan if something bad happened. And then we've got your collateral security. Again, that is not the largest one we look at, but in the case of like real estate for the business to be in, that one is a safety net for us because real estate, as you know, has been going up and up, especially in the Dallas area. That one we're more comfortable with, but we don't look really at collateral as a car very well. I'm sure many of y'all bought a car and tried to sell it later and it's worth less than you owe. So that's really the way bank looks at it too. And then your questions to consider for your cash flows. So this is again what we look at. So is the applicant's industry stable? So again, that's talking about oil field would have volatility a lot. Different things such as restaurants. They are typically stable, but you also we look at them as higher risk, and that's just because I think it's something now like every 3 in 10 fail. So we have to look at different scenarios depending on your specific industry. So this is again where I said when you're making your case to the bank, you need to specifically understand your industry and your business so that you can tell them what is your difference than the rest of it. Because if everyone around you is closing up shop, but you're making a profit, there's obviously a good story to tell, right? So that's what you need to be able to tell your banker. Then the financial condition. So are the profitability and cash flow sufficient? What's your current level of debt? Will you be able to afford more debt? Is there liquidity in the business? So all that's talking about is what is the cash in the business right now. Obviously, if you're needing a loan for $100,000, you've got a loan for $50,000 already, and you've only got $3,000. That's kind of a little worrisome. Like, can you really sustain more debt? And then the maturity of the business. So as you are in the business longer, we look at you more favorably, obviously. So longer in business, or also the management team. So if you had a history, in whatever company you're trying to start professionally, outside of it, you manage something, you've been a business partner somewhere else, we look at that also. And the guarantor support again is what is the financial condition of the guarantor? And then we look at the collateral security. Again, we're looking at that more of like real estate, more favorable than probably a lot of other collateral. Many equipment though will last a long time. Depending on manufacturing equipment, might last 30 years. So that's obviously a lot different than someone going over there and buying equipment such as a computer, right? I mean, how good is a computer for, what, 3 years, 4 years, starts crashing? You know, they come out with something new, etc. So those are the kinds of things that we look at as well. How long can it last before it needs to be replaced? And then again, is the amount requested within our lending parameters. So we want to also look at, well, you know, do we normally give a loan out this size for equipment, or do we normally give out a loan this large for a vehicle? So, you know, if you're trying to get some kind of specialty vehicle that's not something the bank normally does, the community bank or wherever it is might not be comfortable with it. Alright, so this is the important part, so we can go there. These are the ratios, you know, that we look at and we're trying to approve you for a loan. So the business debt service coverage is the ratio of your cash flow to your annual debt obligations. So basically, I'll explain that a little bit more, and then you've got your leverage, your ratio of your debt to your equity, and then your personal debt to income. So here we look at the different way it works. So your cash flow is the sources of cash coming in. So your profit of your business, hopefully not your loss. Your depreciation and your amortization. So what that is we add back in, you know, your vehicles and equipment as it's depreciated on your taxes. Thankfully, you save money with the tax man, and then we add it back to help you get a loan. So it actually helps you both ways. Then you've got your interest expense. You know, if you've got a loan outstanding, we add the interest back in as well. And then you've got your rent expense. So let's say you're renting a property, and you come to the bank and say, you know what, I'm tired of renting for the last, 5-10 years. I've got the money now, let's buy a suite, or let's buy a restaurant or a building or whatever it is. Then you're going to go ahead and we'll add in all that rent expense. So if it's $10,000 a month, we'll add $120,000 a year to your bottom line when we're trying to see if you can approve for a loan. So you got to think about it that way. You can't just go, well, I didn't have a big profitability, but I really want to buy a building. We're gonna add back all of your rents. So that's very helpful for y'all. And then your debt service is your total debt service. So what's your interest and principal payments on mortgages, auto loans, leases, term loans, lines of credit. And I do want to say all of these are for the business, okay? This specific cash flow that we're talking about is all the business. We're not talking about your personal mortgage and your personal auto loan, okay? And then we're looking at your business leverage. So we're looking at what are your liabilities and then what are your equities. So if you have $100,000 in outstanding loans and you have $5,000 in cash, you can kind of see where that leverage ratio, you're highly leveraged. So that ratio doesn't necessarily mean that you can't get a loan. It means that we might go to alternative areas like the SBA to help get the loan. And then the personal debt to income ratio. So this is where we will talk about the same thing that we just spoke about, except on the personal side. And the reason that banks look at this is because if you're highly leveraged and you can barely afford your personal debt, it kind of worries that can you afford more business debt, right? Because we kind of look at this more of a ratio of around 45-50%. So if you're making $1,000 a month and your expenses are $500 or more, you're kind of lopsided and you're not really living within your means. It means that you're maybe living in a house that's too much for you. You're buying cars that aren't really for you yet. It's not that you can't get there. It's just that where you're currently at is not in the bank's eyes, a sustainable practice for either your business or personal. So this is where we're talking about your debt service coverage. So the debt service coverage is really simple to figure out. We take your net profit of your business in a year. We add your interest that you've paid all your credit cards, all your loans, leases, whatever. We add that back. We add depreciation of all of your assets. So whatever you depreciated, whether it be business vehicles or equipment, we add all of that in there, and then we say, okay, for example, that's $100,000 a year is what you've got. Now we're trying to figure out that you've got a loan request. The loan request is $25,000 a year in payments. obviously it already looks good, right, when you just think about it, you know, without a ratio. So what that is that's actually 4 to 1, and you see that we need to be at 1.25 to 1.4. So you kind of got to think about that, and you can kind of prepare yourself on your own before you even see a banker with what can I afford? Can I really go ask for this loan? Am I in the position right now? Or do I need to wait a little bit longer? And your leverage. So again, the leverage is your assets and liabilities. So we don't want you to have 3 times more liabilities than you do assets. And when we add in your assets, it's your cash, the value of all your equipment, the value of your inventory, everything. So we're going to add all that in there. And if your leverage is 3 times or less, you're going to be passing that second test. And then the third test is that personal debt to income that I mentioned. The lower the debt to income, the better. Actually, some of these, if you're so much better in one of these than the other, it will actually kind of push you along and let you overlook one of the other 3. Now, if 2 of the 3 were bad, you're probably not going to be able to make it work. And it obviously wouldn't be in your best interest anyway to make it work. Because as you can see there, if 2 of the 3 of those were bad, that means that you have too much debt either personally, you have too much debt on the business, or you just can't afford a loan right now. So even we don't want to ever put you in a situation where not only do you owe the bank, but we gave you money and set you up for failure. That's not really what a bank is about. Okay? So this is one of our, this is a little bit about Capital One. We've actually did not become a bank. I know they show you all these years back here. Capital One didn't actually become a bank until 2005. So everybody probably remembers Hibernia. Hibernia was here. And we've kind of grown from there. Now we've acquired and acquired and acquired. We bought ING Direct, you know, online banking. And we've kind of gone from there. So when I try to tell you this is that what sets Capital One a little apart is we're more of the entrepreneurial spirit. The bankers in the field are more have more control, I guess, over decisions. And they also are more in the communities than you'll see in bigger banks. And what I mean by that is that a good example will be Hibernia. Capital One was buying Hibernia when the hurricane hit, okay? Capital One sent people to Hibernia to help before the merger was completed. You don't even know if the government's going to approve it yet or your shareholders will approve it. They sent 1,000 employees to go help. So that's kind of like their commitment to community spirit. And, you know, they were helping keep the branches open, making sure people got the money they need, the loans they needed to rebuild, whatever it might be. So that's kind of, you know, a little bit about Capital One and where we've come. Now this is the disaster planning. You can go to the next. So this one is basically you just need to think about yourself and key personnel in your business. What if something happened to my brother or my sister as part of my business? What would happen? Let's say, again, I know I keep going back to this, but it's the easiest one to explain. You own a restaurant, right? You have somebody that's the manager of the restaurant. Manager of the restaurant, you know, God forbid, gets cancer, okay? What happens to the business all of a sudden? How's it going to run? Who's going to step in and take that role? You know, is it going to be you? Do you have time to do that? Do you have somebody set up and trained to do that? That's something you really got to think about ahead of time. That's just for key personnel that would happen about. You also have to identify who can telecommute. So again, when all the power and stuff goes out, even Capital One has people that work from home, get on the phone and make sure that when you call for help, we're there. That's the same thing you can do for your business depending on what it is. And then the external contacts. So if you've got critical vendors or contracts that help you with anything, you want to make sure that you have all of this in a, you know, like a, we'd say an Excel document is the easiest thing because you can store it on the internet and, you know, access it anywhere. I don't think I'd put anything on actual paper. You never know. I mean, what if your office or building or business burns down, right? And you need to continue doing business, but you don't have to have the actual property to do it. If you've got stuff in the cloud, as they say, or Excel, you know, trying to keep stuff all organized on a computer, you'll be able to access it from anywhere and continue to do your business. And then your critical equipment. So this is your personal computers. Do you back up your personal computers? Do you set those up automatically to do that? Because if you don't, what if one day it crashes and everything that you do on your business is on the computer? So it's like the opposite of having a fire. Now you've got it all on the actual computer. It crashes and you have to start over. Do you have all the contact information for everybody that you need to know? Supplier information, you know, whatever it is. And that's why I highly recommend either online backups or using something like a cloud to store your data in. And then identify critical documents. So you've got your articles of incorporation and legal papers and stuff like that. I would recommend that you have all of that ready and either store it in like a safe deposit box, or maybe your attorney has a copy of it, something like that. At the very least, you should keep important documents in a fire safe. So if something happens, it burns everything down, at least you still have all your legal documents. They cannot be recreated as easy as you'd like. And then contingency equipment options. So if it uses trucks, truck got damaged in a fire, where would you rent the trucks? What would you do? You got to be prepared for something bad like that to happen. What if the vehicle's in an accident? You've only got one vehicle. You had one employee driver. He's in an accident. Who picks up? Who's the driver? Who's now gonna drive a new truck? And where are you gonna get the new truck? It's the same thing for somebody you have that's your main salesperson. Maybe you're not too much of a salesperson in your business. Something happens to them. What happens to your sales? You got to think about all those kind of things and kind of have somebody trained and ready for it. And then what about computers? Can you use a business service outlets for copies? So those are everywhere now. That one's not really something you got to think about. I'm sure everybody's sitting in FedEx offices everywhere. You've got libraries. You've got lots of options now to get around that. And then you got your location. So where would you go if your primary office is unavailable? So that we call that like a safe haven for a bank. That's where we would go in the event of a fire or shutdown or something like that. And then a how-to. So what would you do? How should you do it? And how? So you kind of need to have this again. I would put it on a digital document, not a piece of paper. But that's something you do need to think about. So a BCP, which is a business continuity plan, is useless if it's all over the place. This is again why I say have it organized in the cloud or on a Word document, something that you can save digitally. If you've got some of it at home, some of it at your business, I mean, how is that helpful? You know, it's not going to be good for you. Communicate. So make sure everyone in your company knows about the BCP and how it works. Test the plan. Pretend that there's a disaster happened. I know it sounds a little silly, but these things happen. So let's pretend my truck broke. So you go with your backup plan. You call whoever your contact is right away. See how quickly they could get you a truck just to see how it would work. Whatever that situation is, whether it be employees or equipment, go ahead and kind of test that and see what would happen. And then you want to have a plan to change and revise it. Maybe you made those phone calls and did it, and guess what? The vendor that you had on your Excel document that was going to help you, when you made it 3 years ago, they don't exist anymore. Because how often are you really going to go back and look at it if you don't test it? You're going to create this thing now because you're getting your business going, and you're going to forget about it. So if you test it once a year, you're going to have all the stuff, information updated, and you'll be ready if something happens. So this is kind of a place to go, and I can email this out so he can give it to everybody. So this is on ready. Sorry, wrong key. Just hit backspace. Yeah. So you got your emergency plan. So you're going to have this. Again, you can store it online. There's a website you can use though. Okay. Now we're good. All right. That's actually it. So you can go to the end slide. This is a succession plan, so I'm not doing that. Okay. So yeah, if there's anything that you guys need, again, I'm going to email this out to you, but you've got my email, you've got my office number, my cell phone. Any questions that you have about any of this, I'm open to help anytime I can. And again, I own a small business myself, so I know about all of these different things that you have to go through. Okay? Does anybody have any questions on any of this, or something that jumped out of them before we go?
What type of business do you own?
A travel agency.
For the line of credit, you said up to 250,000?
Yeah, so with us, up to 250,000. Just renews every year, just keeps on going.
So when you apply, is it according to you find it?
Again, it's going to be according to what the business and all those things that we talked about. Can the business afford it?
Okay.
Is the business too highly leveraged, etc.
Okay. So the line of credit is for working capital,
It should only be for working capital needs.
and for the loan is for like economic.
Exactly. If it's something, it's a loan. If it's not something, it's a line of credit. Easier way to do it.
Do you just like manage this whole type of process, or do you actually help the people do like the loan and stuff that you talk about?
No, we help them figure out where they're at now and where they need to be. There's several people that I talked about 2 years ago, told them what they needed to do, they listened to me. 2 years later, we gave them the loan that they needed. Sometimes it's been a year later.
So you willing to work with us, you saying, throughout this process?
Yeah. If you have questions anytime, not a problem. Not a problem. Anything else? All right, well, I appreciate it.
Entertain